Welcome back to Business Week here on Arise News. Nigeria's economy is running on a treadmill, moving but not moving fast enough. The latest GDP figures tell a sobering story. Growth may have ticked up to 3.4% in 2024, but in real terms, our economy shrank by a staggering $168 billion thanks to a currency meltdown and structural inefficiencies. And with GDP per capita at an all-time low, the reality for millions of Nigerians is simple: higher costs, lower earnings, and fewer opportunities. Now, this isn't just an economic statistic. It's a symptom of Nigeria's widening output gap, the space between where our economy is and where it should be. Manufacturing stalling, agriculture underperforming, and investment policies lagging behind. Well, to help us unpack all of this today, I'm joined by none other than Tilewa Adebajo, the CEO of the CFG Advisory, who has deep expertise in economic strategy, investment policy, and capital markets. He's here to help us break down the numbers and make sense of what it will take to help us unlock growth. Good morning. You're our magician this morning, in a sense. You're going to tell us what we need to do to come out of this hole. So GDP came in at 3.4%, but we have a growing population at 3%. How real, how consequential is this output gap?
It is indeed very consequential. And I think that from the last segment of your program, you came out with some of the data for GDP growth broken down by sectors. And if you take a look at the manufacturing sector, it only grew by 1%. Even if you take a look at the nominal GDP growth for the manufacturing sector, it was 4%. So I think that tells you that there's significant issues, especially with productivity, if your manufacturing sector, which is supposed to be your base, is not working. Trade is also even lagging. And if you take a look at the trade terms, in terms of the nominal growth rates for trades, you're seeing something much better. So you can see that it's not a pretty picture, from what we've seen. So therein lies your output gap, because if your manufacturing sector is growing by this amount, and so where's the growth? And your GDP in real terms is shrinking, then of course it's a big issue.
Yeah, indeed, it's a big issue. And so the question then is that $168 billion gap or fall in GDP.
Yes.
You speak to people and they say it's the FX issue. But I'm thinking FX alone is accounting for that slump, or it's really the structural inefficiencies, isn't it?
Definitely. It goes beyond the FX because if you take a look at the GDP over time, if you take a look at 2014, when our GDP was close to about $600 billion, so if you take a look at between that period of time, our GDP has gone from $600 billion to $200 billion. Incredible. So we've lost $400 billion in our GDP over a period of time. So now, the question I always tell people who are talking about the $1 trillion economy is that if you had gained $400 billion in
instead
your GDP,
of losing it, we would already be there.
Thank you.
Right. And it's not just an FX issue.
It's not just an FX. The FX just excavates the whole situation. So that's really where we are. So that's where the issue is.
And when we then compare Nigeria to other countries like Kenya, Egypt, they've had similar economic pressures to Nigeria, but they've still maintained their GDP values around the sort of same range over the same period. So what is fundamentally wrong in the structure of the Nigerian economy?
Well, the structural inefficiencies, and when you're taking a look at the policy over the last 18 months, we've gone through a lot of instability.
Right.
Looking at this year, the first 2 months of this year, and I think we're achieving now stability. So I think stability has returned to the system. And so what the issues now are is how do we grow the economy? How do we build on the stability to grow the economy? Those countries you talk about, including Bangladesh and Vietnam, they're exporting apparel and textiles to the value of about $40 billion.
And there goes the point about manufacturing.
Exactly. Yeah. So they have a vibrant manufacturing sector that is driving exports to the tune of about $40 billion a year just on apparel exports. And that is the size of our reserves. So, and even the search in terms of our oil output, in terms of our exports, that is where we are. So, this is really where the challenge is. And you can see, like I've said, the numbers are reflected in the GDP numbers.
Indeed. And, when you look at the oil versus non-oil contribution to GDP, non-oil is like 90-something% from what I could see. In a sense, that says we've somewhat managed to diversify a bit. Have we, in reality? Or is it just the focus on revenues that matters when it comes to diversification as opposed to GDP contribution to GDP?
I think you've hit the nail on the head. So the Nigerian economy is not really an oil economy.
Yeah.
So there are many other sectors of the economy that dwarf the oil and gas industry.
Right.
The oil and gas industry at best is maybe 8% of the Nigerian economy.
It's
I think it's about
5.5% now.
Yeah, it goes between about 5 to 8% of the Nigerian economy. So it's mostly agriculture, services, and trade that drives the Nigerian economy still. But in terms of the revenue from foreign exchange,
it's still oil.
Oil and gas.
Meanwhile, oil has the smallest proportion of GDP compared to. So what does that say?
Well, that's really where you need to manage those distortions.
Yeah,
and that's why you have a sovereign wealth fund, because most of these oil-producing countries have set up a sovereign wealth fund to be able to manage the surpluses from their oil exports and to be able to channel those resources to be able to diversify and invest in other sectors of the economy.
Yeah.
And that is what we have not really accomplished in Nigeria, managing those surpluses through a sovereign wealth fund.
Yeah. Now, maybe looking at Nigeria's fundamental economic ideology and principle, some people would look at it and say we're pursuing a very free market model insofar as trade is concerned. But then you look at our trade policy and what we're trying to do compared to other countries. Where do we really need to accelerate growth and reform insofar as trade is concerned? And the reason why I say this, the world is sort of dividing insofar as global trade. We see in the US imposing tariffs. It seems like some markets are closing. And now we're talking about diversifying, exporting more. What should our response be to ensure that we make the most of the time and get our trade growing, get our exports growing, and get revenues diversified from different sectors outside of oil?
Well, I used to be a senior technical advisor to the Minister of Industry, Trade and Investment for 3 years. And one of the things we did while we were there was that was the year we banned the importation of cement.
Right.
We had conducted a study with UNIDO to look at the capacity of production for cement in Nigeria. And when the study came back, I think the minister made the recommendation to the president that it was indeed time to ban the cement importation, and all the cement manufacturers were called in for a meeting. We've achieved success, not only in cement, but fertilizer and also refining now. With the Dangote refinery and all the other NNPC refineries, Nigeria is closing in on a million barrels a day capacity in refining. That is quite impressive. And so we need to build on these successes. And these policies need to be deliberate, because the cement policy started under President Obasanjo, who was very deliberate in pushing the policy of that import substitution.
So are you for trade protectionism?
It's not more about trade protectionism, if you see what I'm saying. But if you take a look at, for instance, let me zero in on something in particular. You saw that your manufacturing sector is growing at 1%. So that's a problem. If your manufacturing sector is growing at 1%, that's the output gap. There's low productivity, and there are challenges within your system that is not encouraging manufacturing.
Right.
So what is happening now is that you are trading $25 billion a year with China. You are importing goods worth $25 billion a year into Nigeria from China.
And you're making China richer.
So basically, apart from making China richer, China is undermining your industrial or manufacturing capacity. And when people talk about dumping, it's not that you're dumping physically, but basically you're undercutting the pricing. So China is manufacturing at a cost that is cheaper for our local industries to manufacture. So what the Minister of Industry, Trade and Investment needs to do now is to tell the Chinese that you have $25 billion worth of imports from China into Nigeria every year. So you need to bring your Chinese companies into Nigeria to manufacture those products.
Set up the factories here.
and employ Nigerians to produce these goods in Nigeria and possibly for the West African sub-region to be able to satisfy the demand of 200 million Nigerians.
Yeah.
Because this is a situation where our population is an asset, not a liability.
Absolutely.
So these are the deliberate policies that you need to engage in your trade negotiations with China. And you have to break down all those imports and look at where are the areas that you believe that you can manufacture
Absolutely.
here. And that is really where the deliberate policies come into
Indeed.
play. So it's not so much about tariffs, but it's about strategically looking at your industrial policies to be able to sit down with your largest trading partners. Okay, China is one, what is coming in from India, what is coming in from other parts of the world, and begin to see what can be manufactured here. Because we have a 200 million population, and it's the same strategy that China used to develop
Absolutely,
its own...
it's a demographic.
Exactly.
And you know, the interesting thing you said is, whilst it's not trade protectionism, there's import substitution, it's also about really leveraging what our competitive advantage is.
Exactly.
Insofar as manufacturing. So it's not a blanket approach where you just, you have to actually dimension which goods
Exactly.
we can manufacture here
It has to be
locally,
deliberate.
competitively, efficiently. Interesting. I want us to switch to another issue. Nigeria's public debt burden. We're currently at 150 trillion naira.
Yes.
We have very limited fiscal space. What is our best strategy now for restructuring that debt? Because if we don't, then our ability to do other things will be hampered.
Yes, I think I've mentioned this very clearly, that it's now time to optimize equity within the capital structure of the balance sheet of the federal government of Nigeria. And my advocacy comes again around the oil and gas industry. We have significant amount of very viable oil and gas assets. In nominal terms, last year, the oil and gas industry grew by 30%, nominal GDP growth. So that is a positive sign, because a lot of all these agreements that have been signed, I think there's confidence being restored to the oil and gas industry. The oil and gas industry used to have investment of close to $22 billion a year.
Yeah.
This was about 5-6 years ago. That has dropped to $3 billion. So we need to go back to those levels of investments. If you do that, then you increase significantly output, which brings revenue to the government coffers. So not only will that begin to help you manage your debt burden, but the way to accomplish that is to sell down some of these assets to the private operators who can now go with the incentives of going to raise money to increase and boost production.
Yeah.
So in the process of selling assets, not only do you raise about 30 to 40 billion US dollars, but then on the other side, you increase oil production and your revenues coming. So it's a double win. So with all those revenues, you can, offset some of your debt profile and, pay down your debt to a manageable level, restore your credit ratings, because right now our credit ratings abroad at junk bond status, but thankfully our sovereign risk spreads have narrowed to a 5-year low.
And that seems to be a bit of a contradiction. On the one hand, sovereign risk spreads have narrowed, credit rating still a junk bond status. Is it a perception issue from investors? Or is it something that the Nigerian government itself can do within its control?
Yeah, there's still those structural issues, which talks about the debt profile. When they see that you're beginning to move in a different direction, the demand for your debt instruments have increased, because we know that if there's anything you want to say about Nigeria, Nigeria does not have a default risk. If there's anything you want to say about Nigeria, Nigeria is not going into a recession.
That we know.
So that it's clear. I think that's the sort of stability we've achieved. So how do we build on that? So what the markets are saying is the fact that these instruments now become more attractive. And the more demand for those instruments, then the risk spreads decrease. But you still have the structural issues of managing that debt profile.
Yeah.
And that is what remains. And once you correct that by maybe selling down some assets, paying down some of this debt, then you can begin to see a more favorable credit rating.
Indeed. It's almost like you've done enough to achieve stability, but now you really need to drive growth and attract me to actually come and invest and take on more appetite. This is sovereign risk from Nigeria. But let's look at another issue here, which is really around the investment inflows into the country.
Yes.
You talked about oil and gas. Interestingly, we have seen some stability in oil. We saw the first FDI in the deep water in more than 10 years taken last year on the back of some of the fiscal incentives that the government introduced in the energy sector. But overall, looking at the investment makeup, investment flows, whether foreign direct investment and foreign portfolio investment, are we now in a healthy era in terms of FX inflows into the country? Are we likely to see any other major shocks? I know you will tell me about, well, let's look at our oil revenues, but there seems to be some level of stability. The Naira has been appreciating. FX liquidity is improving. You know, am I getting a sense where we're entering a very nice and sweet zone here, or should we be wary?
We shouldn't be wary, I think, because what is happening is that I've always asked people a very simple question. What is the demand for foreign exchange in Nigeria? Your largest trading partner is China.
Yeah.
Most of the demand for our imports is $20 billion from China every year. But China doesn't use dollars.
Yes,
China uses renminbi or yuan
yeah.
as a currency. So why are we chasing the dollar? That's number one.
Okay.
Number two, what is the value of the total demand for dollars? Our exports range between $50 to $60 billion, and our imports are about the same, about $50 billion every year. So what is the demand for foreign exchange in Nigeria, including everything that we're doing? I don't think we're up to 50 billion. But if you take a look at our diaspora remittances, they're looking at about $25 billion a year. The central bank also sells the FX they get, the NMPC does. So what we are seeing now more, I believe, is a transparent system. The panic and the uncertainty with the free fall we saw earlier with the currency has disappeared. So there's more stability in the markets, and now you have a new Bloomberg system terminal that does open transparency. So, and what is happening now is that we're telling the Bureau de Change operators that, you know, it's not, you do not look at the markets, the market rates and call it official, because there's nothing like an official market. It's one market.
Absolutely.
So, but what happens is that some of the parallel market operators and the Bureau de Change operators look at those market rates, the interbank market rates, look at it, and then they now decide they want to make a premium on it. And then they put 50 naira on top of it.
Starts.
And that's really where it is. No, you should also be part of that market. So when you're seeing price discovery and panic has reduced and there's stability, which is what is important, and people are confident they can plan. And another thing that people take for granted is the fact that this subsidy issue is behind us now. I think we all realize now that we're going to pay between 850 naira to 1,050 naira for fuel. So depending on what the price of
where you go now.
Yes, where you go or what the price of oil is. So you know, we all know what the price of petroleum or products or PMS is and diesel. Once you have energy costs stable and sorted out, that impact will flow through the economy. And you know, those are the sort of stability we're seeing, which will invariably impact the FX markets.
Yeah.
So people are no longer panicking.
Yeah, I mean, one of the things you said in a recent write-up was really around self-sufficiency in sugar production.
Yes.
Which is really compelling, and this could actually help us. It could be a staple FX earner.
Yes.
What more do we need to do in terms of reform for that segment and other parts of the agricultural food value chain?
You see, that's what I'm talking about, the focused approach which you've talked about. You know, you've talked about looking at what you are importing from China, getting them to set up that particular industry. Now, we already have 3 massive sugar refineries in Nigeria owned by Dangote, Bua, and flour mills. Now, these refineries have capacity to produce sugar for the sub-region. So not only is it a potential foreign exchange earner, but it's a major African continental free trade area project.
Yeah.
So how do you optimize that? Because these refineries are still importing raw sugar from Brazil or wherever it is, and they're a major FX utilizer. So why haven't we created the productivity for the Nigerian farmers to be able to grow sugarcane at the levels that will support those 3 refineries? So that is another output gap.
Yeah.
You see, because if those farmers were productive and they were growing sugarcane to support an investment we've already made, then we'll begin to see significant growth in our GDP numbers.
Absolutely.
And then we'll begin to see more diversity. So we need to begin to, like you've said, dimension and target those areas. So it's a strategic approach. not only in agriculture, but also then you can now begin to put necessary incentives. Because yes, Dangote has built an $18 billion refinery. So where is Dangote putting the next $18 billion?
Yeah.
Where is...
he may think twice for a while before he does that.
Yes, but that is what we're saying.
That is exactly what we need more of that at that scale. You know, it's interesting.
And he mustn't think twice.
Yeah, well, I won't blame him if it takes a bit of a break for multi-billion-dollar investments. But you know, it's interesting. You know, when I talked about the 186 billion drop in GDP.
Yes.
If you take maybe 3 or 4 key sectors, like sugar, and some of the, between them, like 3 or 4 sectors, that 886 billion is nothing.
Yes.
They could literally help us plug that gap with a targeted focus approach to some of these sectors. We've run out of time. I wanted to ask you what the top 3 priorities for the government. I think you've kind of mentioned them, but summarily, you know, what would you say should be our focus in short term for the rest of 2025, out of all the things you said, very briefly?
We need to dimension the economy, and we need to provide incentives to these sectors of the economy that will grow and close the output gap. That's number 1. Number 2, we need to sell down our assets, our JV assets, to be able to improve our debt profile and return our credit rating to investment grade.
Sure.
That's
and
number
the final
3.
one?
The final one, the government needs to stay the course.
Okay.
Okay, we need stability and we need clarity in economic policy and coordination.
Absolutely.
Coordination of monetary policy, fiscal investment, trade, and policy. Investment, trade, and industrial policy, which is talk about the dimension.
Yeah. Hopefully the stay in the course one sticks, because we've got literally about 2 years till the next round of elections. But that's another story. Thank you so much, Mr. Adebajo, CEO of CFG Advisory, for being with us today. Thank you.